Welcome to the TrestleBridge Capital Market Observations Call for the week of January the 23rd, 2023. I'm your host, Eric Jefferson. To kick things off here, we have a few quick words from our legal team. With that, we can go ahead and get started. Like to start, as we historically do, recapping stock market. Last week, S&P had the first weekly decline in the new calendar year, down just shy of 1%, ended at a price target of 39.99.09. That is 91 cents short of $4,000. Granted, it is up in early trading to kick off the new week. When we think about performance year to date, S&P up over 3.5%. Again, that was through the market close last Friday. But interestingly enough, that performance has been driven by some of the lower quality and most heavily shorted names, which may be more to do about short covering as opposed to confirmation that the bottom is in, and now we have this dash for trash. To quantify that, if we look at stock performance in calendar year 2022, the top quartile, or the best 25% of stocks collectively on a year-to-date basis, are up just around 1%. If we look at the worst 25%, or the bottom quartile of performing stocks in last calendar year, on a year-to-date basis, up over 16%. So again, clearly some confirmation that the beaten down names are starting to play some catch up. A question, obviously, though, is where do we go from here? Last week did get some fairly ugly economic data, some slower manufacturing data, as well as very softer than expected retail sales. That is obviously a measure of consumer spending. And where consumers make up 70% of the US economy, that is somewhat alarming. Again, when we think about what drives consumer behavior, one, it could be sentiment. Are folks worried about a recession and therefore they're not going out and spending? Or two, are folks just so beaten up by inflation and higher prices to the point where they've now depleted their excess savings they built up during the pandemic? Now they can no longer afford to go out, maintain the lifestyles that they had before, and thus are slowing down. Either way, neither of those necessarily an encouraging indicator. The flip side, though, we did get softer than expected inflation data. One of the many measures or readings of inflation that confirmed inflation has in fact peaked, something we all by and large accept at this point, and is continuing to trend lower. That obviously helped buoy some of the appreciation for risk assets. More broadly, as we think about the outlook ahead, again, economic growth clearly slowing and slowing quickly, but one thing to keep in mind, the market is not the economy. Slowing growth will not necessarily or not directly translate to equity volatility. Rather, it's falling stock earnings and earnings multiples. That being said, where we have such a strong labor market with employment being as strong as it is, very unclear what impact, again, those two somewhat contradictory themes will have on market environment. To sort of further muddy some of these waters, arguably there are three of the biggest disconnects in today's market as we try and interpret the various signals and indicators with respect to where we go from here. Currently, as we've talked about, it's earnings and earning multiples that drive stock prices. We see one of the biggest gaps between the earnings outlook. So what are we hearing from companies as they give some insight into what they anticipate for the road ahead versus what the market is currently pricing in via forward estimates? Historically speaking, anytime you have such a big disconnect, that tends not to bode well for stock prices. However, the flip side, we've also never had a wider gap between what the Federal Reserve has said with respect to the outlook for higher interest rates and what the market is pricing in, which is two more modest rate hikes, February and March, followed by rate cuts towards the end of this year. Historically speaking, market typically is right more than the Fed is, which would be a bullish case or encouraging for risk assets. Lastly, though, to possibly break the tie here, within the bond market, we have one of the most inverted yield curves that typically has a very cautionary message with it, which again is at odds with the equity markets currently pricing in a fairly mild recession. So a lot of mixed data out there. At the end of the day, I think it's hard to see the market trade meaningfully in any one direction, again, until we get some clarity. Something then to think about, how do you want to be positioned, again, with obviously a lot of unknowns on the table. As we think about the week ahead, do hear from some big auto names, a handful of credit card companies. I think that'll be interesting, less to hear about the corporate earnings, more so about what insights can they share with respect to the consumer. Again, credit card spending can be interpreted one of both ways. It's encouraging if people think we have a bright future ahead. They're going to go out, they're going to spend money today because they're not worried about making money tomorrow. Flip side of that argument, if we see credit card expenditures tick up, there's also a case where consumers are so tapped out or have seen their savings depleted in the face of higher prices. They're now leveraging, relying more on credit in order to fund their lifestyles. That obviously has some somewhat negative implications. Additionally, later on this week, we'll get the estimates for Q4 GDP. Again, that will obviously give some indication of where are we with respect to global growth. Undoubtedly, it is slowing at this point. At what rate really becomes more of the focus. And then lastly, we'll get some additional inflation data, specifically PCE, the personal consumption expenditures. Of all the different inflationary gauges or metrics out there, this is the one that the Federal Reserve arguably pays the most amount of attention to. So something, again, clearly inflation is falling. We've seen that reflected in the data. The question, or emphasis rather, is how quickly, what is the rate of falling prices as we now have a race towards getting back down to that long-term average of 2%. Additionally, and something that we've talked about, there's both headline inflation, which is the top line or the big number. Then within inflation, there are different components. There's the more volatile food and energy. There's the stickier core piece, which oftentimes includes more services versus goods. I think the question specifically is going to be on what do some of those stickier pieces of inflation, what are they doing? Because obviously impossible to get down or back to those long-term averages absent of some progress there. Not by any means to discredit the progress that we've made on the headline number. Not surprised that has resulted in some more optimism. But again, longer term, in order to get a sustained, meaningful shift in the Fed's interest rate policy, do think we need to really start to make some progress on some of those stickier service sector pieces of inflation. Hopefully by week's end, we'll get some better insight there. That's all for now. As always, happy to discuss anything in more detail. If you don't connect, have a great rest of the week. Take care.